Welcome to our proactive tax planning tips for 2021. I'm Paul Hutton, president of Hutton Wealth Management. Today our goal is to provide some helpful tips for anyone that has already filed your 2020 tax forms and for those that are still looking to file, and also to give you some proactive tax planning tips for the year 2021. Before I begin, I find it always important to review the 5 key areas of financial planning. They're preservation planning, retirement planning, tax planning, estate planning, and investment planning. Even though today's presentation is about tax planning, as a comprehensive wealth management firm, we try to always consider the impact of any recommendation that we make, not in just one, but in all of these areas for our clients. Proactive tax planning should always be the key focus when reviewing your personal financial situation. One of our goals is to point out as many tax saving opportunities and strategies as possible for our clients. This workshop will review some of the broad tax issues and some potential tax reduction ideas. So as we go through this workshop, please remember that not all ideas may be appropriate for everyone. This workshop is for informational purposes only, and we always recommend that you address any tax strategies with your tax professional first. Let's look at some helpful information for filing or understanding your 2020 taxes. In 2020, there were 7 federal income tax brackets. Here are the tables for the most common ways, which are single, head of household, married filing jointly. The amounts in each bracket are slightly adjusted from the prior year due to inflation. The lowest bracket of the 7 is 10%, and the top tax bracket is still 37%. Also, the standard deduction, should you not itemize, is shown for each category. Should you itemize, a major tax change that still has a big impact from 2017 Tax Cuts and Job Act is the state and local deductions. That if you take, they're often referred to as the SALT, S-A-L-T, and this is limited to a combined total of $10,000 or $5,000 for married taxpayers filing separately for state income and property taxes. This deduction limitation is currently set to remain intact through the year 2025. Now, long-term capital gains are still in favorable tax rates, and they're more efficient than ordinary income. Those rates are 0%, 15%, and 20%. So, long-term capital gains are usually better tax-wise than any other types of incomes. Now let's talk about charitable donations. Charitable donations are still deductible for those who itemize. However, if you do not itemize, starting in 2020, the CARES Act created a new charitable deduction available to taxpayers who use the standard deduction and do not itemize their deductions. This new benefit, known as the universal deduction, allows for an above-the-line charitable deduction up to $300. To qualify, the charitable gift must be in cash or some kind of an equivalent made to the qualified 501c3 charity and should have been made before December 31st of 2020. As the tax form here shows, it is the new line 9 on your tax form. Retirement plans funding is always something you should consider. If you have not already funded your retirement account in 2020, there still could be plenty of opportunity to do so. So explore. If you can, please check with your tax preparer or call us for more information on that subject. Here's some commonly overlooked tax items and deductions. The reinvested dividends. This is not a deduction, but it is a calculation that is important for tax purposes. Many investors have mutual funds or stock dividends that are automatically used to buy extra shares. Remember that each reinvestment increases your tax basis in that fund. That will in turn affect your capital gains calculations when you redeem shares. Please check that your statements keep records of good statements and things like that, so when you need to do this, you can do this properly. Forgetting to include reinvested dividends in your basis could result in a double taxation of dividends. once in the year when they were paid out and immediately reinvested, and later when they are included in the proceeds of the sale. If you're not sure what your basis is, ask the fund, or you can ask us for help. Next is the carried over items from prior years. Don't forget this, from carry over those items from prior years, because you exceeded annual limits such as capital losses, charitable contributions, and certain tax credits. Please make sure if you switch tax preparers that they see your prior year's return in the year that you're doing your taxes. Now let's talk about charitable gifts directly made from IRAs. Individuals at least the age of 70 and a half can still exclude from gross income qualified charitable distributions known as qualified charitable distributions, or QCDs, from IRAs up to $100,000. What this means is these distributions must be made directly to the charity from your IRA, not from your IRA to you and then to the charity. Remember to double check on what counts as a qualified charity and distribution before trying to execute this strategy. Now let's look at some helpful proactive tax planning strategies for 2021. Let's briefly look at the 2021 tax brackets. There's still 7 federal income tax brackets that have been slightly adjusted from 2020. Long-term capital gains are still currently scheduled at favorable rates. It's never too late in the year to start contributing to your retirement plans. So if you have any questions about your retirement plans, give us a call. We'd be happy to discuss that with you. You might want to examine taking advantage of the annual exclusion gifts. For 2021, the maximum amount of a gift tax exemption is $15,000 per person. For example, you can give that amount to a family member without having to pay any gift tax. Some ideas could include, if you want to bless a child or grandchild, you can pay them up to $15,000. They can take that money and invest it into an IRA. You didn't have to pay the gift tax. They didn't have to make the gift tax, and the money went into a retirement plan. Or gifting to a 529, which is a tax-sheltered plan for college expenses. The new above-the-line charitable deduction we showed you earlier for those who do not itemize increases in 2021 from $300 to $600 for taxpayers married filing jointly. For individual filers, it's still $300. Also, it could be helpful to formulate your 2021 tax projections. We already know what the 2021 rates are. A qualified tax preparer should be able to review your 2020 situation and all of your 2021 expectations for income so that they can provide you with a 2021 tax projections. Here are some other proactive tax planning strategies, because we believe that taking a proactive approach is better than a reactive approach, especially regarding income tax strategies. So if you're close to the standard deduction level, strategy to consider is a term that's called bunching your charitable deductions into a donor advised fund. This is what's called a DAF. As this example shows, someone who is slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor advised fund in 1 year. This could bring the taxpayer a much larger overall tax savings, in this example, over 3 years. Then, as the other side of the screen shows, from the donor advised fund, you can still give to your favorite charity each year. Now is the time to explore if it is helpful for your tax situation to deposit cash, appreciated securities, or other assets into a donor advised fund and then distribute the money to charities over time. For more information on this, feel free to give us a call and we'd be happy to discuss this with you in more detail. A critical area to review in tax planning is what we refer to as the family tax bracket management. If you have a retirement assets that are not in Roth IRAs, when and who takes the distribution can make a huge difference from a tax standpoint. Simply put, if you are in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than yours. However, if your beneficiaries are in a higher tax bracket than you, then it might make sense to make the distributions in your tax bracket. Convert these IRAs to Roth IRAs and then leave them in an account that still has to be taken out over 10 years after your death, but now can grow tax-free for up to 10 years. A key step to explore in considering your marginal tax bracket and your beneficiary's marginal tax bracket each year. That is something that we try to think about for our clients with large retirement accounts. For some people who might be exploring a Roth IRA conversions, this could be helpful. Here are some benefits to the Roth IRA conversions. They can lower your overall taxable income over the long term. Roth IRAs enjoy tax-free compounding returns. Roth IRAs have no required minimum distribution. Roth IRAs allow tax-free withdrawals for beneficiaries. Whether to convert part or all of your traditional IRA to a Roth IRA depends upon your unique situation. It is best to prepare a tax projection and calculate the appropriate amount to convert. There are several pros and cons to making this change. Please call us or talk with your tax professional or advisor before you making this kind of a change. Qualified charitable distributions, we talked about this earlier, QCDs, are still a strategy for retirement savers in 2021. This provision allows retirement savers to directly distribute up to $100,000 to eligible charities straight from an IRA account after age 70 and a half and not pay taxes on the distribution. One idea that experts suggest is that if you're charitably inclined, to consider using part or all of your required minimum distribution if you're over the age of 72 for qualified charitable distributions. Like many other strategies we're discussing today, this is one that you should see us about if you're interested in evaluating your unique situation. So what can you expect from us, guys? You can expect regular communication, more frequent discussions. You can expect that we are continuously reviewing economic, tax, estate, and investment issues for our clients. We hope that you received our special tax report that we sent out earlier this year. If you haven't, let us know. We'll be happy to get that over to you. Or if you'd like a copy sent to someone you think that may benefit from the information, give us a call. We'd be happy to share that report with them. Or we'd be happy to send it to you and you can give it to them. I want to thank all of you for your time today. Remember, your health and well-being is our highest priority. We appreciate the opportunity to assist you with your financial needs. Here's something I need help with this year. Can you help me in 2021? In fact, we would be honored if you could share the names of some of your friends or family, or forward this presentation to them, or let us know. We will send it over to them so that they can benefit from this information as well. I want to thank you again for your time today, and remember, a proactive approach can many times lead to better results than a reactive one.